Business leaders are anxiously awaiting Ottawa's economic update. Boosting competitiveness is at the top of the agenda for a lot of companies, including New Flyer Industries, North America's largest bus manufacturer. New Flyer recently announced it will be moving some jobs south of the border due to regulatory challenges. For more on this, we're joined by Paul Soubry. He's president and CEO of New Flyer Industries. Good to see you. Welcome to the show.
Thanks, Greg.
All right, let's talk about the fall fiscal update. Let's start there. Canadian CEOs are clearly worried about competitiveness. It's interesting that you recently announced that you had to move some jobs south of the border because of regulatory issues by America. So clearly, there are some pressures on Canadian industry.
Well, you know, our business, 90% of our revenue is the United States. About 60% of our revenue is for government customers in the United States. And the FAST Act that was passed in 2015 required the U.S. content of material and components to go from 60 to 65% last year, and it goes to 70% next year. And so we can resource materials that we were resourcing in Canada or elsewhere, but to try and get to that 70%, we found ourselves having to take high-dollar components that were manufactured in Winnipeg and move them south. It's unfortunate from a Winnipeg job perspective, but the reality is we're dealing with U.S. taxpayer dollars, and our market's the United States, and so we had to comply.
I know you were pretty well diversified even before this move in terms of having a presence in the United States, but the regulations really forced your hand even to go deeper, considering that?
Well, absolutely. You know, when you think about a transit bus or a motor coach, a $500,000 U.S. purchase price, the largest components are obviously large U.S. sourced engines and axles, air conditioners, those kind of things. And so to meet the requirements, we've got to find different sources of material and components that go into that bus. And so that change in the FAST Act required us to have to rethink about some of that supply chain. And so the only way to really do it was for us to actually set up some of our own capability in the United States, make our own parts, and sell to ourselves.
Now, that act's been in place, as you said, for a couple of years, separate of the drama that we just went through with the Americans, the new NAFTA, the USMCA, of course, the threat of tariffs. How is all that playing into the business?
Well, you know, from an operational perspective, when the U.S. put their tariffs on, and then, of course, the Canadian surtaxes or tariffs on steel and aluminum, you had this dynamic of trying to understand the impact on our business. The good news was our ability to import U.S. steel, fabricate it into a shell of a bus, and ship it back. And so we actually were the benefactors of tariff clawbacks or duty relief type programs. The whole U.S.-Mexico-Canadian agreement, the dynamics around obviously had a shroud across our industry and in terms of concern of change of regulations. From our perspective, we don't see a change if it's passed as was agreed. And so looking forward to just getting that kind of noise behind us to go back and focus on business.
Would that help the share price? I was telling you before we started that when I host the Market Call-in show, Market Call tonight, a lot of investors, a lot of Canadian investors want to know what's happening with New Flyer and what's happening with the shares. There was a time when investors couldn't get enough of the stock and the industry. Right now, you're down 30% year to date.
You know, it's painful to watch a business focus on its core, to operate, to continue to improve the business, enhance, adds through businesses through acquisition, and then to watch, the share price change. At the same time, like everybody, we're laser focused on the long-term health of our business. And so short-term sentiment around trade issues or stock price dynamics or competitive issues, I think in our minds have been way overblown. We're really comfortable. We're about a 45% market share in North American transit buses. We're about 45% in motor coaches. Got a good-sized parts business. We've bought a smaller business in the United States last year. And so we're really excited about the future of our business. And so, we can't control the stock price, but we can control our business, and that's what we're doing.
Now, with the stock at this level, you're yielding almost 4%. Is the dividend safe?
Well, our view has always been, because we're making buses an essential service, it's almost like a utility-type business where it's not crazy rapid growth. And we've always believed that the dividends are an important part of our story. And so we have got into a cycle the last couple of years of looking at the dividend. We topped it up almost 37% in 2016 and went up by about 15% last year. We wouldn't have put the dividend where it is and had we felt that it wasn't sustainable. It's a big part of our story, and we're really pleased with our ability to do that. And at the same time, invest in our facilities. We've ramped up capability, we've ramped up part fabrication, so I'm pretty excited as we go into 2019.
In terms of selling buses, have you been frustrated at the pace at which it takes to get infrastructure dollars at the door? I think of the American election campaign. I think of the Canadian ones, now several years behind us. All the talk was about infrastructure. Of course, eventually that gets down to the municipality level, the people who buy buses. Frustrating for you?
Well, it's government procurements, and so there's multiple bidders. There's very detailed specifications. It can take year or years for those specifications to be defined. Keep in mind that our type of customer has got a multi-year fleet replacement plan, and so it's not necessarily what they want and what they need to rejuvenate their fleets, the reality of trying to get the funding aligned and so forth. And yes, there's been some challenges and frustrations with a few delays here and there, but to give the Canadian government credit and the U.S. government, they've been fairly forthcoming with those kinds of fundings for our type of product. And so it's not different, it's kind of business as usual, and has been.
If there was one thing that you could have in the fall fiscal update tomorrow, and the minister would say, fine, I'll put it in there for you, Paul, what would it be?
Well, our world, again, we've got 6,000 people. We're half roughly in Canada, half in the United States. As I said, 90% of our revenue is in the United States. The U.S. change of the tax rate and the dynamics around that has now got us thinking about our business going forward and so forth. And so I think the federal government needs to think about the competitiveness of our tax system relative to the U.S. and other places around the world.
All right, thanks for joining us, Paul. Pleasure to have you.
Thank you. Pleasure.
Paul Soubry, President and CEO of New Flyer Industries.